Let's bring in Dan Scott now, Executive Director and Deputy Chief Investment Officer at Fontobel. He joins us on the line from Zurich. Taimur Baig is still with us here at the SGX. Dan, let's start with you and give us a word on Europe, because the sense that I'm getting is that the currency, the euro, really seems to be in the box seat right now. I've heard calls for 125, 127. Can the listed exporters handle that?
That's exactly an issue. I mean, we're still overweight Europe. The underlying fundamentals, as far as we see, are still very strong. But it is the case that going into fourth quarter earnings, we're very vigilant on where the euro is and what kind of an impact that's going to have on earnings. Excuse me. And it could be that the market is somewhat disappointed if we start to see earnings-related hits with the fourth quarter results because of the euro. So that definitely is a focus point for us.
Hi, Dan. This is Taimur Baig from DBS. I wanted to get a sense from you about, what are companies seeing both in terms of orders, because we see the PMI going strength to strength in Europe, even stronger than what we've seen in the U.S. But at the same time, what's happening with cost? Is there any sign of wage or cost pressure eroding into margins, or can we expect these strong orders to translate into very good numbers for European companies for the foreseeable future?
Well, there definitely has been some wage inflation. We've seen it. It hasn't had a knock-on effect on margins yet, though. As you point out, especially for the core economy for Germany, IFO just goes from one strength to the next. And if anything, the concern that we have here is that we slowly get into a situation where we start to see an overheating. So things are very good on the underlying fundamentals, especially the core of Europe. In the periphery, they're also starting to catch up. You're starting to see an improvement in underlying economic data out of Italy, also in economies like France, starting to really pick up. Housing data there as well starting to pick up. So there we see strength in the underlyings. But if anything, the risk is now moving to being very late stage, starting to see some sort of an overheating as reflected in those record high levels of IFO and other lead indicators.
Dan, you like Japan, and let me just challenge you, if I may, on that view, because there is a sense over here that the Bank of Japan may start talking about an exit strategy. If they do, then the yen could gap higher and spoil the party.
Yeah, well, currency is always something to keep in mind, and we always take our positions with currency in mind. So depending on what your local domestic currency is, to hedge that position. For Japan, our view is basically on a number of prongs, though. It's not just valuations. If you take a look at the long 25-year valuations, equity multiples, Japan is actually still very cheap. So that's one of the reasons why we like Japan. The others, though, relate to the fact of restructuring that we've seen and the fact that demand is coming from the consumer side less so than the export side. So that's another positive for us. And then we also see the fact that in terms of earnings revisions, Japan actually leads the globe. From a regional basis, Japan has some of the strongest earnings revisions. So we see the momentum as ongoing here for Japanese corporates.